Someone could spend 30 years investing perfectly, picking the right funds, staying calm through every crash, and they could still end up with less money than someone who had an average portfolio, but a marriage where both people were rowing in the same direction. That sounds like something you'd hear at a couples retreat, but this has nothing to do with feelings. This is simply math. Because the market grows your money, but your household decides how much of that money actually survives your real life. And that either works in your favor or it works against you. There's no in between. Most people can tell you what their portfolio returned last year, but almost nobody can tell you what their household structure cost them or made them in that same year. And by the end of this video, you'll see exactly where that money hides. There are 5 invisible returns inside a marriage, and most of them are bigger than people expect. The first one is something called scale, and it's the simplest to understand. Take 2 people sharing one roof, one set of bills, one kitchen, one insurance plan. A single person pays full price for all of that. A couple doesn't pay double. They pay something like 1.3 or 1.4 times the cost, depending on where they live. That gap between what one person pays and what 2 people share, that's money you can invest. Let's say that gap is about $800 a month. That's $9,600 a year. If you invest that at 7% for 25 years, it grows to over $600,000. And that didn't come from a stock pick. It came from sharing a living structure. Now add in things like filing taxes together, bundling insurance, spousal retirement benefits, survivor benefits, estate rules. None of that feels dramatic in any single month. But stretched over decades, it compounds into serious money. And honestly, this is one of the weaker returns out of the 5. Helpful, sure. But the one that changes everything has to do with what happens when life falls apart. You see, in the stock market, there's a concept where if your portfolio drops 50%, you need a 100% gain to get back to where you started. The math is brutal. A big drop hurts more than a big gain helps. The same thing happens in life. A job loss, a medical emergency, a car wreck. These aren't only emotional events. They're financial shocks. And what decides whether a shock sets you back 3 months or 3 years? It's not your income. It's your structure. Picture someone living alone who loses their job. Rent still hits. Insurance disappears. Savings get drained. Investment contributions stop. And now the job search is happening under pressure, which usually means accepting something worse, something that pays less, something with no growth, because the bleeding has to stop. That's a reset. Compounding starts over from a lower number. Now picture the same event inside a household where 2 people are coordinated. One income drops, the other holds. Health insurance stays. The mortgage gets paid. Nobody panic sells their investments. And the job search happens from a place of stability, not desperation. The compounding cycle never breaks. And that's the most valuable return. Not a higher upside. Fewer resets. Because every time life knocks you off course, your wealth building starts over from scratch. A household that absorbs a hit without falling apart doesn't only protect money. It protects the path that creates money. But hold that thought. Because even resilience is still about things that happen to you. The next return is about the mistakes you make all on your own. And that one might be the most uncomfortable to hear. Every financial plan ever written depends on one thing, whether the person actually follows it. And most people, left to their own habits, don't. Not because they're dumb, but because they're human. Impulse spending after a bad week, upgrading your lifestyle the month after a raise, pulling money out of the market during a downturn because the fear in your gut is louder than the math on the screen. These aren't rare mistakes. They're what people do by default. Now imagine this. One spouse gets a raise and immediately starts browsing for a nicer car. The other asks one boring question. What does this do to our 5-year plan? That question sounds small. Over time, it is anything but small. Because a second person inside your decision-making changes the quality of every choice. Not a financial advisor who checks in once a quarter. Someone who lives inside your daily rhythm. Someone who catches a bad pattern before it turns into an expensive habit. And here's what's funny about this. The best strategy you quit loses to the average strategy you stick with. A spouse who keeps behavior steady is protecting the one thing that decides whether any financial plan actually survives real life. A household with that kind of discipline doesn't only spend less. It holds strategy longer. It tolerates discomfort better. It delays rewards more consistently. And over time, that consistency creates a gap that looks like brilliant investing. But it's something else entirely. It's the system baked into everyday decisions. A good marriage changes the kind of decisions you're even capable of making. And that detail becomes important later because it connects directly to the next return. You see, the first three returns protect and preserve wealth. This fourth one creates it. Think about what it actually takes to make a big career move. Going back for a certification, switching industries, surviving the first 2 years of a business, taking a role that pays less now but opens a completely different earning path 5 years from now. Every one of those moves requires runway, and not only financial runway, structural runway, someone to keep the household running while your income is shaky, someone to absorb the extra weight long enough for the bet to pay off, a spouse who carries more of the household load for 2 or 3 years while the other one levels up. That's a deliberate move that produces future income most people never unlock. And the numbers matter here. A career jump from $65,000 to $110,000 doesn't change 1 year. It resets the baseline for every year after that. Retirement contributions change. The opportunities available to your kids change. And the window of support that made it possible might have lasted 24 months. Now think about it from the other direction. One household can survive a temporary income dip because the structure can flex. Another can't because every hour is already maxed out. So the promotion doesn't get chased. The relocation gets turned down. The business stays an idea on a napkin. Those decisions never show up on any balance sheet, but they represent real money that never got created. And the reason it never happened had nothing to do with the economy or the market or a lack of talent. It was the household. We'll come back to that in a second. Now, everything so far explains how wealth gets built and expanded. This is where the outcome gets decided. Because the same system that builds wealth also determines how much you keep, as losses compound faster than gains. Divorce alone can wipe out years of careful saving, legal fees, duplicate housing, splitting assets, splitting retirement accounts, custody logistics. Depending on how complicated it gets, the direct damage can land in 6 figures before anyone has even started rebuilding. But the direct costs aren't the biggest problem. The biggest problem is what happens long before a household ever reaches that point. One partner starts hiding purchases because every money conversation turns into a fight. The other stops planning because planning feels pointless. Bills get paid, but strategy disappears. Income stays high. Net worth stalls. Two people who could be building are instead canceling each other out. And it spreads. One spouse makes a big purchase out of frustration. The other retaliates by walking away from the budget completely. Nobody raises the real issue. Both keep earning. Both keep falling behind. From the outside, the household looks fine. Inside, money is leaking through every crack. Here's a pattern that plays out way more often than people admit. A couple earns $180,000 combined. On paper, they should be building wealth fast. But the household runs hot. There's no shared system. Every purchase turns into a negotiation. Every money conversation feels like a fight. After 10 years, they've built far less than a couple earning $110,000 with a structure that actually works. Income didn't decide the outcome. Coordination did. Remember that idea from earlier about how your household shapes the decisions you're capable of making? This is where it shows up most clearly. The stock market only compounds the money you manage to keep. A marriage that's falling apart is one of the fastest ways to make sure you don't keep much of it. So, 5 returns, scale, resilience, behavioral correction, ceiling expansion, loss prevention. None of them show up in a brokerage account. None of them get tracked in a portfolio app. But added together across 20 or 30 years, they can match what the market delivers, sometimes more. The people who build wealth over decades aren't always the ones with the best investments. A lot of the time, they're the ones whose households stop destroying the returns. Ordinary incomes, extraordinary stability. Meanwhile, high earners with misaligned households keep watching the gap grow between what they make and what they actually keep. The difference was never the salary. It was never the fund. The market grows your capital. A strong marriage grows the system that earns it, protects it, and points it in the right direction. So before you go optimize another portfolio, maybe figure out whether your household is protecting what you build or quietly eating it alive.